All right, thank you again for joining us today. Today is Thursday, October 27th, 2022. This is the National Housing Resource Center's Leaders in Housing Counseling webinar, and we're going to go ahead and get started for today. Before we get into everything, I do have a few items I'd like to go over. We want to know where you guys are watching from. So if you can, in the chat box, put in your organization and the city and state and where you're watching from. Also, this webinar is being recorded. If there is anything that you missed today, or if you aren't able to stay on, a copy of this webinar will be sent out within 24 hours. The PowerPoint presentation, it will be added to the chat box and will also be sent out with that email along with the webinar. Closed captioning has been enabled. If you need to utilize this service, please toggle your mouse at the bottom of your screen and click the CC button. At the end of everyone's presentations, there will be a question and answer session. So if you have any questions for any of our presenters, we ask that you put your questions within the Q&A box and not the chat box. The chat box constantly rolls, and we don't want to miss any of your questions. So please, if you have any questions, please add them to the Q&A box. We also ask that you follow us on our social media pages. You can take a quick screenshot of this if you want to follow us on our Twitter, Facebook. Our YouTube channel has all of the National Housing Resource Center's Leaders in Housing Counseling webinars. So if there's anyone that you missed and you want to rewatch any of the ones that you already attended, you can watch it there. We are also on Instagram and our website. Please visit us on our website at hsgcenter.org. We also invite you all to join NHRC. There are many great benefits for becoming an NHRC member, not just supporting the important work that we do, but we do have some member benefits that we will be going over at the end of this presentation. So I think that's it for me. I'm going to turn it over to Bruce Dorpalin, and he's going to take it from here. Thank you so much, and please enjoy this webinar.
Thank you so much, Ebony, and please think about joining NHRC if you're not already. And also, if you're new to these calls, you should just join our Leaders in Housing Counseling listserv. You can, I'm sure that one of us will post the link to it, but we regularly post lots of relevant things about housing counseling, the work you do, advocacy opportunities, and a lot. So we're going to do a quick set of updates, and then we'll move into the main topic here, which which we got the wrong heading on, which is about using rent payments to pay for so how the underwriting world is using rent payments today, and how the expansion is. So you all know credit reports do not include rent routinely, and the idea is to capture positive rent payments and be able to use them in the automated underwriting systems. And Fannie and Freddie have had a system for doing that in place. It's been for a little while, and FHA has just implemented or is about to implement one. And both of them are expansions. There's big differences between them, but I think we want to really do this deeper dive because it's very important to understand how your clients might be impacted by these, when there are opportunities, when you would want to, I think you have to make some decisions very clearly about which ones apply to which clients, and people are more in a cash economy, so some will be more effective than others. We'll hopefully get into a lot of that detail in the future, but this is an important advancement in being able to really help people expand the opportunities for qualifying for a mortgage. Also, besides having great representation from FHA, from Fannie and Freddie, FHFA, we'll also have Fannie and Freddie, and we'll also have Chi Chi Wu from National Consumer Law Center, who's doing a lot of great work around credit, and she'll provide a bit of a consumer view of a lot of these too, and things that we should all be thinking about. So that will be the session. I'm going to, I've actually been looking forward to this for a long time. I think this is a really important conversation for us to have. I'm glad we got such a good both turnout and participants from the industry. So just very quick updates. We did get the FHA letter in calling for a reduction in the mortgage insurance premium, the MIP, and calling for 25 to 35 basis point reduction, and also asking for an end to the life of loan on mortgage insurance payments. Partly we want to reduce the cost for how it impacts people, but also we feel like especially the life of loan really is a wealth. It's taking wealth out of the communities. It's if you're going to a traditional conventional mortgage, your mortgage insurance will disappear after 7 years, or when you get 20% equity. With FHA loans, if you have 10% down or less, you'll be paying the mortgage insurance premium for the life of the loan. One of the things I think that will also be important is if we're going into a recession, lowering the overall cost of the loan. So we do hope that this will also apply to existing loans. Do not know the answer to that question. So we haven't gotten a reply from FHA on this. We sent this to Secretary Fudge, but we have been hearing that it's under serious consideration. So that's helpful thing. We hope that 120 groups signed, so heavy turnout from this list, and the local housing counseling agencies were about 2/3 of the list. So that was great, and a good strong turnout from housing advocates and support groups as well. I'm going to stop there, but only to make one plug that we are looking for more of these kind of cutting edge presentations we can do that really help people understand and do your work more effectively. So if you've got some great thoughts, there's a lot that's changing in the underwriting world and how electronic information is handled. We are very interested in trying to provide useful information in that part of the field. We're very interested in thinking about how Asian populations, how folks intersect with our work, and how we can serve the Asian communities more effectively, AAPI. And we're also interested in, if you're doing any work in trafficking and in domestic violence, we know it's an area that HUD has raised some interest in, and we'd love to know what you're doing in the field and trying to fashion an opportunity there. And I know there's talk among some of the housing authorities about doing outreach, financial literacy outreach to residents. And is there a role that housing counseling can play? So if any of you are doing that kind of work, please let us know. We'd love to feature both what's happening nationally and practitioners who are actually doing the work in the field. I'll just mention one more thing. We really had a great session on student loans last week. Really, really helpful. It's a deep dive. There's a lot of dense information in there. And that's posted now on the YouTube channel and our website. So if you didn't get a chance to see it, it's worth pulling up and taking a look. So with that, Christy, do you have any legislative updates today?
Hello, everyone. Yes. So recently, Congress passed a continuing resolution on October 1st, and it will continue funding until December 16th. So that is around the time in which we will hear more about top line numbers for FY 2023. So we've been meeting with different congressional offices. Yesterday, we met with North Dakota's Senator Hoeven, and we had 4 different housing counseling agencies join us. And so right now I'm working to set up a meeting with ranking member Kay Granger's office. She represents Tennessee. So if you are a housing counseling agency in Tennessee and you'd like to be involved in this meeting, please message me on the chat or email me, and we can be in touch. Currently, congressional officials are campaigning in home states and home districts. So if you you have a chance to see them at a campaign event or a Get Out the Vote event, I highly recommend mentioning housing counseling assistance. We're advocating for $70 million in FY 2023. So if you're able to weigh in with them personally, that would be really great. So yeah, that is all happening. And I look forward to giving you the next update. Thank you again for joining us.
And
All
Ellie,
right. Thanks, Christy, for those updates. Hi, everybody. Just a few updates. So you've all heard a few times, those of you who have been on our calls have heard a few times from Eric Moore, our outreach coordinator, about the job board and the jobs that he is posting there. So he's been working really hard in researching the open positions, and also doing outreach to folks who might be interested in considering housing counseling as a career. So as of right now, our job board we have 40 active jobs and we have 29 resumes posted. So if you have a job that you would like to post, you can go right to our job board at the link there and post the job. And you can also check out the resumes that are there and see if anybody fits your needs. Eric has also been reaching out to organizations when he does post a job that is in your organization, so be looking for that. I do one last thing I want to say about the jobs, just so you all know, when the job gets posted, it is live for 60 days. And then we have a default set up so that once it's been on the site for 60 days, it doesn't show up anymore. So if you've posted a job that was more than 60 days ago and it is still open, let us know and we will make sure that it gets that it is visible again on the list. So I want to make sure everybody on the call understands that we have a servicer escalation list for housing counselors. This is for housing counselors only to use to connect with servicers that you're working with a homeowner and you've tried everything that you can to make things happen the way you know that they should, but you keep running up against some kind of issue. These escalation contacts are available to you. The link is here. If you want the password, email me at the email here in the PowerPoint, and I will get the password to you. And then finally, as Bruce mentioned, we are looking for what topics you might want to have covered. He mentioned a couple, but if you have others that we aren't thinking about or that you think would be useful, please write them in the chat. What's also helpful is if you have resources for folks we can connect with to be panelists about the topic that you're thinking of. So again, put them in the chat or email me directly with any items that you want to discuss. And with that, I think we can just move right ahead into the meat of our presentation about using credit in underwriting. So we'll start out with, I want to introduce Julianne Joseph, who is the Deputy Assistant Secretary for the Federal Housing Administration's Office of Single Family Housing. That's a mouthful. But Julianne has been there for more than 16 months. She is, in addition to being responsible for a portfolio of more than 1.3 trillion single-family mortgage loans insured, she has the overall responsibility of managing the almost 700 administrative and professional staff who are responsible for developing, managing, and enforcing single-family policies within the agencies. She has extensive mortgage industry experience, having served as a loan officer, and hear this, as a housing counselor, policy advisor, and now presidential appointee with FHA at HUD. So welcome, Julian. Thanks for being here. Take it away.
Thank you. Thank you so much, Ellie. And thank you, Bruce. It's such an honor to be here with you guys. Thank you to NHRC. And thank you so much to the Housing Counseling Network. I know that we're here to talk about positive rental history and access to credit. But I would be remiss if I did not take this opportunity to thank you all for all of the amazing work that you all have done and continue to do through the course of the pandemic on behalf of the Secretary and Secretary Fudge and our Commissioner Julia R. Gordon. Thank you so much. Thank you, thank you, thank you. It cannot be overstated the sacrifices that you all have made during the course of the pandemic with your time and your resources in order to help these borrowers. while there's been lots of conversation about the servicers and what they've done, you all are such an invaluable partner that for those borrowers who would not pick up the phone for the servicer, they will pick up the phone for you. I understand that very well, just as Ellie mentioned, that I was a foreclosure counselor in 2009, 2010 in Baltimore, nonetheless, at Neighborhood Housing Services of Baltimore. So I understand what that dynamic is like when people are at the end of their rope, are afraid to ask for help. And oftentimes the housing counselor is the only one who they trust to help them get out of that situation. So thank you so much for all that you all are doing. The work continues. We're trying to find as many resources as we can to expand our loss mitigation options, to give you more tools to help these clients who are in need, but we will continue to work with you all. So thank you. So with that, I will talk a little bit about our really exciting development. On September 27th, we rolled out a mortgagee letter that announced that we would start incorporating the use of positive rental history in our automated underwriting algorithm. We use the total scorecard. The lenders utilize that. That helps generate pretty much a rating for our borrowers, our FHA borrowers that are seeking funding. But how we are incorporating this new policy is almost as a compensating factor for those borrowers who are over 620, but may have a little bit of challenges as far as their credit is concerned. Perhaps it's credit utilization. Maybe it's just the fact that they're young and that they haven't had that much time in order to establish a credit file that would result in a higher score. Or it could just be the amount of debt. Perhaps student loans are hindering their credit score. But what we wanted to do, when I first took the seat, I reached out to my team and I wanted us to start looking at access to credit, even though a lot of our focus was on loss mitigation, because we knew that at some point we would have to turn our attention to expanding FHA financing as well. In doing that, we've been working with our wonderful partners at the enterprises at Fannie and Freddie, and as well at FHFA, on working on how to report positive rental history. And we also wanted to utilize our resources at FHA on a dual track, how we can utilize the actual credit application to capture that information. So we could also be able to assist those borrowers who may not rent from a property management company that would participate in credit reporting. So what we decided to do was utilize the total scorecard. So when a borrower comes in, and again, I want to preface this by saying that this is for first-time home buyers. When they come in and, to qualify, let's say, for example, that they try to run the loan officer tries to run the file and they get a refer eligible for a particular borrower. There aren't any serious delinquencies, but let's just say that, again, it may be an issue of credit score, that they are just too close to that 620. What the loan officer could do is rerun that application by identifying on the application that the borrower has at least 12 months of positive rental history. And what that will do is activate within our total scorecard algorithm that there's a compensating factor. And then once that information is supplied in the application and then decisioned again, if the borrower is able to substantiate that they have had 12 months of positive rental history, then they would get, in essence, credit for that. So we're really excited about it. Now, talking about how to verify that. In our policy, we did not want to make it an onerous process for the lender, for the borrower, or for you all who are assisting these borrowers who may take advantage of this. So all we would require is that the borrower provide a copy of the lease and just evidence of 12 months of payments. Now, when we say 12 months of one-time payments, that means that the payment was made within the month that it was due. We're not getting down to the point where we're pulling out calendars to see that the payment was made by the 5th or anything like that. But if January's rent was due and January's payment was made, we would consider that positive rental history. In addition, we will allow the borrowers to use canceled checks, money orders, Zelle, Cash App, as long as they can identify that amount matches what is on the lease, we will accept it. In addition, we also wanted to take into consideration borrowers who are renting from their parents. So as long as the payment is at least $300 and they are able to provide a lease and able to show those 12 months of on-time payments, they too will be eligible for this policy. Now, again, I mentioned that this is for first-time home buyers. Of course, FHA our endorsements go to 84% of our borrowers are first-time home buyers. So we figured that starting here would be able to impact a large portion of that cohort, the majority of our book of business. But of course, as we begin to collect more data to understand how this particular policy will perform, if it makes sense, then we would consider opening up a little bit broader beyond first-time home buyers to see if this policy would be able to benefit others. We are using the traditional definition of first-time home buyer that's either has never owned a home at all, or if they haven't held title in the last 3 years. So we are extremely excited about this. We're hoping that this will, again, help underserved communities and those borrowers who are just looking to get into the homeownership market. And we'll continue to keep you guys posted on any updates that we have. But again, thank you so much for the amazing work that you're doing, and we look forward to working with you more in the future. So I'll go ahead and turn it back over to Ellie.
Great, thanks so much, Julian.
Absolutely.
So we're going to move on now to the Federal Housing Finance Agency, and we have Bill Merrill, who is an exam manager with FHFA, and he has more than 20 years experience in the mortgage industry, and Kenny Marable, who is a policy analyst with FHFA's Office of Multifamily Analytics and Policy, also known as OMAP, where he focuses on affordable multifamily housing issues. And over the last year, he's worked with Fannie and Freddie on their multifamily rental reporting initiatives. So go ahead, take it away, Bill.
Thank you, Ellie. Good afternoon, everyone. I want to add my thank you. Each and every one of you have added so much to the housing industry, both in helping first-time home buyers gain sustainable access to credit, building generational wealth, or even helping borrowers in the servicing to avoid foreclosure and stay in their homes. You all do so much for the whole country. So thank you all for what you do. We greatly appreciate it. I'm going to cover a couple quick topics. I'll cover rent, but I'm also going to cover a couple other items. And then we've had a recent announcement around pricing that I want to make sure I pass on to you as well. And then I'll be turning things over to Kenny to talk a little bit about multifamily. So as we talk about things like rent, I really want to make sure and stress a couple different things the way we think about it. One is, credit bureaus have been the traditional source for data, but as Bruce mentioned, we're moving away from that. Certainly, it's expanding and the amount of information is going in there, but there's also opportunities to look at other ways to look at things, and that's through borrowers' assets accounts. So as you hear about things I'm going to talk about, they're driven by the ability to look at borrowers' accounts and see how they're doing it, paying their bills or rent inside their asset accounts. It's a new source of information that can be tapped to provide additional access to credit for borrowers. The second way I'd ask you to think about this, very similar to Julian, is that this is a way to move borrowers who may not get that access to account and move them up to get an accept in the automated underwriting engine. So these are only positive abilities to move up and give additional credit to borrowers where it's due. So I wanted to leave those themes with you. The first is rent. Both enterprises implemented rent. So if you have a rental history in your asset account, such as a checking account, both enterprises will use their automated underwriting engine to go out there with the borrower's permission, of course, seek that history to see if there's positive rental payments. Take that in consideration only if the borrower needs it to move up to an accept. So they don't have to provide any information. They just need to provide access to their accounts. It's handled through the engine in the back end. So a very, very instrumental aspect here to additional credit here for borrowers to move in if they have positive rental history. Another couple of things I want to mention that are in that vein is Freddie Mac recently announced them looking at cash flow. So this, I think, is a first step in a larger world. Freddie Mac's tool will go out and look at cash flow. Again, if the borrower needs a little bit more assistance to move up to an accept, if they see positive cash flow, positive payments, and positive balances over a 12-month period, that's another opportunity to assist the borrower. That was recently announced in the last week. So that's really an emerging area where we'll continue to work with the enterprises on looking at cash flow to further help a borrower. This is above and beyond rent. This is just manage your expenses. Another area I want to mention is really around credit scores, and both enterprises today, if you all didn't know, don't need credit scores to make underwriting decisions. Both of them can look at trade lines that the borrower may have. They can consider the borrower's documentation as well as their loan application. And both have the capability to try to underwrite a borrower through the automated underwriting system without credit scores. So I really encourage you to think about that as you continue to build credit history with borrowers, that ability already exists today. So please make sure when you talk to borrowers that there's an opportunity to work with your lender around that. So a real big theme there around continuing to advance forward, looking at the borrower's history outside the credit bureaus, all in an attempt to move and increase sustainable access to credit. I'll talk a little bit about pricing. This is a recent announcement. I'm shifting gears on you a little bit, that the director made on Monday, and I think you'll all be very excited about it. So the director announced that GSEs will be reducing pricing. These are often called delivery fees, or you may have heard them called LLPAs. These are charges that the enterprises look at as far as risk is concerned. The director announced on Monday at the MBA conference that we'd be eliminating those for certain borrowers. So those borrowers are first-time home buyers that have at or below 100% AMI. So clearly a target for affordable lending. It would be 120% AMI if it's in a high-cost area. Also, elimination of delivery fees on Home Ready and Home Possible. Those are certainly products at the 97% LTV level that you're often familiar with. Elimination of fees on HFA loans, HFA Advantage, HFA Preferred. Those are the two enterprise programs. And the last one that she eliminated fees on was the duty to serve loans. So if you look at all four of those channels, you're looking at about 1 of every 5 loans that comes into the enterprises with a clear focus on affordable lending. That should really help borrowers here in eliminating those fees. We're working closely with the enterprises to get those announced out. So appreciate your time. Thank you. Look forward to answering your questions. I often get asked, what advice would I give to housing counselors? I think to the extent that you can help us work with borrowers, especially first-time home buyers, to get banked, to get that credit history out there and checking accounts, you can see from the trends that I mentioned that a lot of the new products that are coming out and are looking at to lift access to credit are looking into those types of asset accounts that are not inside the credit bureau. So those two types of activities, expanding credit bureaus, but also looking at borrowers' asset accounts, will be themes on the go forward. The other thing I would say is please help us out. The industry is heading into a lot of headwinds in the future. So with market rates at 7%, I saw a report from the MBA that loan applications are at 25-year lows. You have to go back to 1997. Credit card debt is increasing. A lot of industry economists are looking at potential recession. And also, if you saw our house price index earlier this week, it showed a slight decline from the last quarter. So a lot of headwinds heading into 2023 where you working with borrowers both for originations and servicing is very critical. So with that, I will stop and I will pass it over to Kenny.
I'm going to ask you a very quick question, Bill,
Yes.
that popped in. How much do those fees add on to the loan by percentage?
It's a good question. It does vary a little bit. Depends on where the borrower falls on the realm there. Let me do a quick check and I'll bring that back here at the end of the conversation. So
Okay.
You're talking about as far as in rates?
That's what it looks like by the question. Once you take the LLPs down, what's the percentage that it would have increased the loan?
Gotcha.
Yes,
yeah,
right.
Great question. Yeah. Let me check on that here in the background while others are talking. I'll get back to you, but it probably will be a little bit of a range, but let me check real quick.
Great, thank you. All right, sorry, Kenny, go ahead.
No worries. Thank you, Bill, and thank you, NHRC for having me speak today. As Ellie mentioned, I work on the multifamily team here at FHFA. And I'm going to speak briefly a little bit about the Equitable Housing Finance Plan that both Fannie and Freddie put out earlier this year, because within those two plans, they both have a initiative where they have a rental reporting initiative where they only report on time positive rental payments. So a little bit of background about the Equitable Housing Finance Plan. The work is really led by our Office of Fair Lending, also known as OFLO, who's leading this work in the equity space. So over the last year and a half, I've been working with them along with Fannie and Freddie, and then specifically on the rental reporting initiative, working with Freddie, who released their initiative late last year. Fannie is getting theirs underway recently. And I think we have folks from Fannie and Freddie who can touch a little bit more on that. But I guess the premise of both initiatives is that, again, it's only on-time rental payment that's being reported to the credit bureaus. And depending on the property, depending on what we call the fintech companies, the Isuzus, Rent Dynamics, these are the partners that Freddie and Fannie are working with for the rental reporting and the collection. Residents will either be automatically opted into the program, which is called an opt-out, or they will have the opportunity to manually sign up for it. So I think one of the key components of that is what we've heard from vendors and initial reports from Freddie and their program is that the opt-out model increases the participation in the program versus residents having to manually opt in. Another key component of the initiative is if a payment is missed, that payment is not reported. If a payment is missed, that won't be reported to the credit agencies. What then will happen is that residents will have the opportunity to withdraw from the program and re-enter, just to make sure that their credit history is safe. I got some background. Freddie, like I said, started late last year. I don't have any updated data from them, but when I last spoke with Freddie over the summer, we've seen a lot of success in establishing credit profiles and increasing credit scores in the properties that they've already started. I know Fannie initiative has just started, so they may not have the data available, but I'll let them speak to that. Throughout this whole process, we spoke to a number of different stakeholders. We met with all the fintech companies that Fannie and Freddie were going to or are partnering with. One of the stakeholders that we met with, you'll hear from today, NCLC, and through meeting with them, we learned a lot and gained a lot of good feedback. But I know Chichi will speak to that a little bit later about alternative reporting and alternative data. The last thing I'll say that I know this is largely geared towards underwriting and credit building for home buying, but I think another key component is for folks who are not yet ready to buy a home, or just for whatever reason not willing or don't want to buy a home. Establishing credit profiles and increasing credit scores, of course, helps in other areas where they want to seek financing. And I think the last thing that I'll say, because it's worth saying, is that under both programs, only on-time rental payment will be reported to the agencies. So what will happen now is every year, Fannie and Freddie have an opportunity to update their equitable housing finance plans and the activities within them. So we hope to gain a lot more data this year through this pilot phase. And then hopefully address any challenges and barriers that we may face. So I'm happy to hear from you all, what you all are seeing. If you have any questions, feel free to ask me. I'll actually link both Fannie and Freddie's equitable housing plans in the chat, if that's okay. If you all want to take a look at that, there's a bevy of activities and different initiatives, included in both plans. And I think with that, I'll just pass it on to the folks at Freddie and Fannie to talk.
Great, thanks so much, Kenny.
Mm-hmm.
So from here, we're going to go right to the folks with Fannie Mae. So we have two presenters with Fannie Mae. Mindy Armstrong is a product analyst for Desktop Underwriter and has been at Fannie Mae for 22 years. Sandra Elmanzan, Senior Director, Affordable Lending and Housing Equity at Fannie Mae, has over 20 years of experience in community lending. Her career has been focused on engaging with the numerous industry partners involved in addressing the affordable housing needs throughout the country. She leads the team at Fannie Mae that engages with the counseling industry and is a key contributor to Fannie Mae's racial equity efforts today. So, ladies, take it away.
You can hear me, right, Ellie? Just checking.
Yes, we can hear you loud and clear.
Awesome. Can we go to the next slide since you did such a great job of introducing us? And just wanted to go through kind of what we will go high level. And I'm happy to say that both Bill and we are all on the same page from a talking points and messaging agenda. So I love that. I love that when we're all on the same page. We'll be talking about underwriting borrowers with non-traditional credit and desktop underwriter, positive rental payment history and desktop and DU, rent reporting initiatives, and average median credit score. And I'm going to try and go through that quickly so we can take your questions. Can we go to the next page? And we'll go one more. So when we talk about borrower eligibility, right, and what DU assesses loans when there's no borrower, where there are no borrowers with traditional credit, or at least one borrower lacks traditional credit, we want to ensure that the overall risk assessment is appropriate for these loans, right? So as we look at for loans where borrowers do not have traditional credit, we want the property to be a one-unit principal residence, right? And all borrowers must occupy the property. Just a keynote, manufactured homes are not eligible for this. Transaction must be a fixed rate purchase or a limited cash out refi. The loan amount must meet the general loan limits. High balance mortgage loans are not eligible. I don't necessarily think that this is our clientele, but just want to be specific about that. And then the LTV, the CLTV, and the HCLTV ratios must not exceed 90%. Our debt to income ratio must be less than 40%. Some of this might be news or information that you all know like the back of your hand, but I want to make sure we're reiterating some of the obvious. Can we go to the next slide? When we talk about non-traditional credit, right, DU provides efficiency for documentation as its requirements are more flexible than manually underwritten loans. So when an approved recommendation is received, right, the lender must document and assess a 12-month pay history for at least 2 non-traditional credit sources for each borrower, one of which must be housing related, right, rent. And that's what we're here to talk about today. If DU does not issue an approved recommendation, the lender may manually underwrite and document the loan according to our selling guide. Manual underwritten loans will require 3 to 4 non-traditional credit sources if a rent source is not available, right? And then I want to particularly note, because this is important, for loans on which at least one borrower lacks traditional credit, if the borrower with the credit score is contributing more than 50% of the qualifying income, the lender is not required to document a non-traditional credit source for the borrowers without a credit score. So non-traditional credit, there are nuances to using non-traditional credit, and I want to make sure that we're staying aware of that. Can we go to the next slide? Positive rental payment history and desktop underwriter. I think that you heard the high level points of this earlier with our presenters. So I'd like to talk about kind of specificities. So where limited credit can be a major obstacle for renters who want to buy their first home, including a history of consecutive rent payments in the application process, more renters may qualify for a mortgage. In the context of our work around our sustainable and equity plans, and you're going to see that in the chat provided to you, we know through our work in the Black housing journey that this is a very important contributor to moving people towards homeownership. So for loans on which borrowers are using positive rental payment history, you need to be a first-time home buyer purchasing a principal residence. You have to have a credit score of at least 620. Non-traditional credit score is not permitted when using this. You have to have been renting for at least 12 months, have rent payments of $300 or more per month, and have bank accounts that document the most recent 12 months of recurring payments. Can we go to the next slide? Things for you to consider and facts that a borrower should be aware of through the application process, right? A borrower must opt in to allow a lender to take advantage of digitally verifying consistent rent payments. So that is something that the borrower has to do proactively. The lender will need to verify the borrower's history of rent payments through information in the bank account statements, but the borrower does not need to provide the paperwork. The lender can do all of this automatically. When completing a loan application, we want to make sure that the monthly rental amount that is paid is put in that application. The lender will verify that recurring payments for the last 12 months have been made, And this applies to rent payments made by check or electronically via any digital payment platform like Venmo, PayPal, Zelle, as long as it appears in the payment history of your bank statement, right? Checking a borrower's bank information for consistent rate payments will not negatively impact their credit score. This is a positive only impact and does not negatively impact their ability or your chance to qualify for a mortgage. Can we go to the next page, please? Okay, reporting rental payments in the marketplace from a multifamily perspective. So what do we know about this from a renter's perspective? How is positive rent payment can provide benefits for current renters and potential future homeowners, right? So a couple of key points here. Our program pilot launched, as it was stated earlier, just launched at the end of September 2022. And it's aimed at helping renters build their credit score through inclusion of their on-time payment to the credit bureaus, right? We know making rent count is important. So because rent is usually the largest reoccurring monthly expense that many households pay, having on-time payments reported to credit bureaus can help renters to buy a home or get a better rate on a loan. We think that this is going to help open the door to homeownership. Having sufficient credit can help individuals qualify for a mortgage. Access lower cost credit, right? Reliable on-time payments and reported to credit bureaus can help renters increase their credit score. Better credit scores obviously lower the cost of financing to purchase a car or start a business or borrow for an education. And they help establish credit profiles, right? So rent payment reporting enables credit invisible consumers to become visible and to build credit. A couple of other just discussion points I'd like to make sure and point out to you all is that we know that studies have found that the presence of rent reporting at a property can have a large impact. And so Isuzu cites that 6 months or longer of average tenancy when people report their rental payments. If there's a reduction in delinquency, Jetty cites a 36% reduction in delinquencies for those that are reporting their rent payment. And then Isuzu cites a 25% increase on timely payment when people are reporting their rental payments. There was a couple, you want to go to the next slide? So for homeowners, for those people who rent, right, homeowners, single family homeowners that are renting, you know, they can also participate in the program. They can participate in the pilot at no cost. We intend to do 1-year positive rent payment services via one of our 3 designated vendors, and they will be reimbursed by Fannie Mae. Reporting rent may increase timely rent payments, as I've just stated you, some of the studies that our partners have done in the marketplace. And it helps renters establish or improve their credit scores, right? Again, stating some of the obvious here, but we're hoping to move people through that dynamic of moving them through a housing journey and get them to the place where they can purchase a home in an effective, efficient, and cost-effective manner. Can we go to the next slide? And then our average median credit score, right? One more. So this is really trying to give you an example of how you use the median credit score to determine compliance with our minimum credit score requirements. So this really provides an increased access to credit for more borrowers. I'm not necessarily going to let you all look at the example for borrower 1, borrower 2, but let me walk through step 1, right, which determine each credit score's borrower's applicable credit score. First, you want to determine each borrower's credit score in the middle of the 3 scores received, or the lower of the 2 when only 2 scores are received, right? And then the second is you average the applicable credit scores for all the borrowers on the loan to determine if the 620 minimum credit score requirement is met, right? So just a couple of notes on this method. This method will not result in a credit score lower than the representative credit score. The average median score will either be the same as the representative credit score for loans with 1 borrower, or the same or higher than the representative credit score for loans with multiple borrowers. So this is net positive. It can only be net positive. It can't be negative to the borrower. Also, I'll note that the average median credit score will only be used in the eligibility assessment, and the representative credit score will continue to be used for pricing or any applicable mortgage insurance requirements, and will need to be provided at loan delivery. I think that's it, right? And so here are links to source material or how to look up some of the material that I've shared with you today. And I see there's already Q&A. I haven't had a chance to look at any Q&A, so I will defer, and I think I will pass it on to my colleague at Freddie, Lewis. I'm sorry, was it supposed to go back to you, Ellie? I apologize.
Is it coming to me, Ellie, or okay?
Yeah, sorry, no worries. Yeah, so let me just do a quick intro. Lewis. So Lewis is with Freddie Mac, and he's going to talk with us about their the program that they use and how they utilize rent in underwriting. So go ahead, Lewis.
Thanks very much, Ellie. So I wanted to kind of broaden the scope a little bit, not just rent payments, to really talk about the expansion of data that we're using in the underwriting process to expand access to credit in a smart way. And that includes rent payments, which is the topic of this webinar, and also something new that we've recently announced, the borrower cash flow assessment. So we'll talk about both of those. Next slide, please. Just a quick legal note here. Some of this, a lot of these things has already been announced, publicly, and I'm summarizing that. But you'll be hearing some things that are not yet public. So this is confidential information. You're getting a sneak peek of what's coming out in about a couple of weeks. Next slide, please. So we'll start with rent payments. Rent payments, we take a two-pronged approach, and I split it up between multifamily initiatives and single-family initiatives. Next slide, please. The multifamily initiatives is what you've been hearing talking about here. The problem statement being we have renters, they don't take advantage, or they don't get the advantage of actually getting their on-time rents reported to the credit bureau. So then, they have lower average credit scores than homeowners. So there's a disadvantage there. And so to help them and help making some of that credit visible, that we're providing incentives to Freddie Mac finance multifamily properties who report on-time rental payments to the three major credit bureaus. And this can be done automatically, as has been stated. So anybody who lives in one of the properties participating, or they can ask and to be able to be opted in, depending on the setup at the property. But it's only on-time rent payments, and that's a very important part that I've heard here. I want to emphasize on our end as well. So since we start, I think it was Kenny was talking about updated numbers. I do have something to report here. So since we started this initiative, which for us was about around this time last year in 2021, more than 98,000 households across 948 multifamily properties have enrolled in this. And that has created over 19,000 new credit scores, and almost 70% of existing credit scores for the renters went up when they started reporting to the credit bureau. So we're seeing some immediate impact there, which we're very proud of. Next slide, please. Single family. We have an initiative that has been described here where we're looking at rent payment history within account transaction data. So the idea here, as Bill mentioned, is we have this extra data source that is basically what's in a person's bank statements, and it gives us insight, that extra insight, which says the borrower has been paying their monthly rent for a renter on a consistent basis. And we want to use that to be able to put it in the credit risk assessment. So we look at the transaction information from a third-party provider who's providing this transaction history from the banks, and then we're putting it into our LPA decision. So with that, we can turn something that would have been a caution before this to an accept for our purchase, eligibility. As far as who benefits from this, it's similar to what you've heard described here, that we did put some guardrails here. This is focused on first-time home buyers purchasing primary residences, and there has to be at least one usable credit score. And the first-time home buyer has to be intending to occupy the primary residence. And with that, there's a minimum of 1 year rental payment history that's required, and there has to be a minimum of $300 of monthly rent. And we could look at this is about the bank data. We can look at what's in there for non-cash recurring rent payments. So things that would come from checks, debits, even things through popular apps that you might pay through, like Venmo or Zelle. We're able to actually identify the rent payment there and considered in our credit risk assessment. Next slide, please. We wanted to show you kind of the flow of what this actually looks like in practice. So it's split up into two sections here. It's an LPA submission with an asset report, an LPA submission, excuse me, without an asset report, and an LPA submission with an asset report. So the top is what's happening probably mostly now because this is new. So for those lenders who aren't in the habit of getting a third-party report that they submit to LPA, they may submit a loan to LPA and get a risk class of caution for our purchase eligibility. And then we will, in the background, figure out if looking at the rent payment history and us being able to identify positive rent payment history or consistent rent payment history will help the borrower. And if so, they will get a feedback message, the lender, saying, please order an asset report. We can consider the rent payment history if we see it in the bank data. And then that lender would just turn around and submit it back into LPA, and that's where the bottom flow goes there. And then we'll take a look at the transaction history, and if we identify that 12 months plus of rental payment history on a consistent basis, then we would be able to consider that and turn that caution potentially into an accept. And I think a good stat here that we've been seeing is that we have a very high, we call a flip rate. So this flow, to take it into account, is going from a caution to an accept in the kind of the best case scenario. We have a 70% flip rate from flow if the borrower, once their message and they order that asset report, links the right accounts, and by that I mean the ones that they're paying their rent from, and that the submitted rent amount that's in the application, which we do consider, matches or is in line with what we're seeing as the latest rent payment debited in the bank data. So we just have those, make sure those two things are checked off. There's a 70% flip rate there. So we're really excited about that. And again, this will only positively affect. So if this flow ends up on us not seeing that consistent rent payment history for whatever reason, they're not going to, the borrower's not going to get dinged for whatever, in whatever manner. It's just going to stay a caution. Of course, the easy path and the one we're hoping for and we've seen is caution to an accept because we are able to see that consistent rent payment history. So that's rent payment history. Next slide, please. But I think the larger topic, which I've heard here, is we have extra information, let's use it. Rent payment is important. We need to have rent payment reported to the credit bureaus when possible. We need to focus on identifying it in the bank data. But the bank data tells us something even more than that. It tells us how the borrower, the individual, is managing their money. So Freddie just announced this borrower cash flow assessment. And what this is, next slide, please, is us taking into account what we see in the bank data, in checking, savings, and investments, and looking for certain patterns that we identify as positive cash flow, and that's money management. There's more ins than outs, etc. And if we're able to find what we call positive cash flow, we will also consider that in the credit risk assessment and give the borrower the benefit for that. And much like our initiatives that we've talked about before, it will never negatively affect the borrower. So if we see something that we don't quite think is positive cash flow, that's not nothing that will harm that's not anything that will harm the borrower. This is going to begin with submissions or resubmissions into our LPA tool November 6th. So that's coming up. Next slide, please. So as far as a little bit more insight into the borrower cash flow assessment, what we're looking are in the transaction, that bank data, are the inflows and outflows. And we're looking for certain patterns that we think show good money management skills. And this includes the transaction patterns that I mentioned in checking, savings, and investments, and also changes in the account balances month to month. We have a lot of insight there that we can incorporate into our credit risk decision. And so you have a loan that would have received a caution, like today even, before, because this goes live in a couple of weeks, would receive a caution, but then we would fire a message saying, please get an asset report. We want to make a fuller assessment by looking at the borrower cash flow assessment, and this loan could benefit from that. And then if the lender went out and got an asset report and they resubmitted it to LPA, we would do the borrower cash flow assessment, and the hope is to flip that from a caution to an accept. What I want to stress here is that we want to make this actionable too, because we realize that getting a asset report may not be in the process of lenders now. We want to make sure the borrowers are benefiting from it. So we are heavily relying on our messages. What I mean by that is that we will message the lender like we do with cash flow when we know that the loan can benefit, this caution loan can benefit from the borrower cash flow assessment. That gives them the opportunity to go a little bit further in their conversations with the borrowers, help them link those accounts there, and help us with the assessment. And overall, this is kind of a win-win. It's going to support this this mission statement of ours, where we're going to be trying to expand access to credit and support sustainable housing opportunities by taking information that we have access to now and using that insight in a smart way, because there is a heavy correlation, there's a strong correlation rather, with positive cash flow and lower default rate. So this is a smart way of doing it, and we're very excited that we're going to get into started soon because we've been working on it for quite a while. With that, I will turn it back over to Ellie. Thank you very much.
Thanks so much, Louis. So we are going to move on now to Chi-Chi Wu, who is a staff attorney at National Consumer Law Center. She focuses on consumer credit issues, including legislative, administrative, and other advocacy. Chi-Chi's specialties include fair credit reporting, credit cards, refund anticipation loans, and medical debt. Chi-Chi's been on a few times before and always has really great information for us. So Chi-Chi, welcome and take it away.
Thanks so much, Ellie, and thanks for having me again on one of your webinars. Thanks to NHRC, of course. Thank you to FHA, Freddie Mac, Fannie Mae, and FHFA for all of your efforts to try to expand home ownership, and these efforts, which, you know, some of them I think are absolutely terrific. Some of them I think are good, few caveats, but I know you're working hard, and definitely listen to us consumer advocates and really appreciate all the work on this. Thank you to the audience members, housing counselors. For those of you who haven't been on a webinar that I've been on before, my name's Chi-Chi Wu. I specialize primarily in credit and consumer reporting issues, and National Consumer Law Center, we do policy and advocacy work. And one of the things I want to offer you is that if you ever have any questions about credit reporting, consumer reporting issues, feel free to shoot me an email. Later on, I'll put my email address in the chat box. We do provide brief technical assistance not to consumers directly, but to folks like yourselves who are housing counselors. So next slide, please. So as with so many issues involving consumer credit and financial products, the devil is in the details. And that's also the case with rent reporting. There's been a lot of attention and a lot of promotion and support of this idea of rent reporting. And, you know, I have to admit, it has an intuitive appeal. You know, it's very, it's a very understandable thing to say, you know, it's not fair that homeowners get the benefit of reporting their mortgage payments to the credit bureaus, but renters don't. And, you know, it's often pointed out that renters are disproportionately Black and Latinx, and so this affects consumers of color more often. And so it's been actively promoted as a racial justice measure, rent reporting. And it can help some consumers. It can help a fair number of consumers who are renters, but there are big caveats. So Louis and some of the other folks who've spoken previously mentioned that Fannie Mae and Freddie Mac actually have two programs involving rent payments. The first type of program is they pick up the information from bank accounts. And that kind of rent reporting or rental data program, we've been very supportive of. We think it's terrific. Most importantly, it can't hurt the renter when it comes to tenant screening, which I'll talk a little bit more about. And it bypasses the credit bureau. So it breaks up that monopoly that the credit bureaus have over data. Right, just today, the Consumer Financial Protection Bureau announced the small business review in a rulemaking involving Section 1033 of the Dodd-Frank Act, which is going to set the ground rules for use of bank account data via third parties that are called data aggregators. It will hopefully, when these rules are issued and go into effect, it'll make the process easier to pick up this kind of bank account information, but with more consumer protection so that consumers can feel more comfortable about giving permission for bank account data to be used. The other type of program involves supplying information to the big three credit bureaus. And again, there's not a lot of effort devoted to that. There are companies, someone, an earlier speaker mentioned Isuzu is one of them, but there's a whole bunch of them that are third parties that are used by landlords to report rent info to the big three credit bureaus. And again, this is pushed as a financial inclusion measure, including by the credit bureaus, because the credit bureaus, it benefits them. It gives them more data. They love it. But it carries risks because those same credit bureaus, you know what? They sell reports and scores to landlords. And a lot of folks, you know, they focus on mortgages or credit, and they don't think about the fact that other entities use credit reports and scores. 90% of landlords use credit information, and one 30-day late negative mark on a credit report can shut a renter out from decent housing. You know, either require them to pay a much higher deposit, or literally we've gotten examples of renters who are homeless because they can't get a landlord to accept them because they have a 30-day late on their credit report from what they call full file rent information. So when you have a reporting of both the positive and the negative information. And there's a lot of tenants who potentially have negative information. You know, we used to think, you know, renters usually don't end up 30 days late because eviction proceedings start, but we had the pandemic. And everybody knows that during the pandemic, millions of tenants fell behind in rent. And because of the eviction moratorium, they stayed in place. All of those tenants would have negative information on their credit reports if there were full file reporting, which could shut them out of housing. The Urban Institute, and in terms of racial justice matters, these tenants are disproportionately Black and Latinx. The Urban Institute just put out a report on rent reporting. And one of the data points I found interesting was that they found only 55% of Black renters had 12 months worth of on-time payments during a one-year period. So all these programs that require 12 months of on-time rent payments, you know, only 55% of Black renters would have qualified. And that means 45% of Black renters, if there had been full file reporting on all of them, would have negative information on their credit reports. So the most important principle for rent reporting is positive only. These programs should only report the positive stuff. And I definitely give kudos to both Fannie Mae and Freddie Mac for that. And I really appreciate they listen. Unfortunately, not everyone has listened. HUD in its Move to Work program, unfortunately, is using full file reporting, and a California law that requires subsidized housing providers to offer the option of rent reporting has been interpreted to require both positive and negative reporting. And by the way, positive reporting is not entirely 100% risk-free because we're not sure how landlords interpret this information. So both the Fannie Mae and Freddie Mac program, the way they work is if a tenant is late, they get disenrolled. And so it just stops supplying information. Well, if you have a credit report with 6 months of positive rent information and then nothing, you know, how is a landlord going to interpret that? Some landlords would be like, fine, but there could be landlords that draw negative inference. And that's because, you know, analytics and, you know, things like recommendation and scoring by tenant screening, it's a very opaque and it's not been tested scientifically, unlike credit scores. You know, other reason, the other thing about programs is we favor opt-in. We favor opt-in and not automatic enrollment with an opt-out for several reasons. First of all, on a policy level, the credit bureaus are this, very strong oligopoly that is not responsive to consumers because we have no choice. By using data outside the credit bureau system, that kind of provides a tiny bit of competition and breaking up that stronghold the credit bureaus have over the data. Another reason we favor opt-in is in some cases, the renters have to pay for this. I mean, generally $7 to $9 a month, but still, these are folks who are, some of them may be struggling to pay their rent. We know that renters are getting slammed right now. Rents are going up. They're also getting hit with lots of different types of junk fees in states that don't prohibit them. We actually submitted a comment to CFPB during its junk fee request for information about junk fees and rental housing. Fees that just help the landlord, like insurance that only covers the landlord, or garbage fees or utility hookup fees. And renters are struggling in this country. And the thing is, you're not going to expand home ownership if you don't protect the renters while they're renters. How are they going to move to home ownership if they barely can pay the rent, or if negative information on their credit report is keeping them from getting affordable, decent, safe housing? And, I know that automatic with an opt-out, you get higher enrollment rates. We know the power of defaults, right? And yeah, 70% of folks get a benefit. What happens to the 30%? Do their scores stay flat, or do they tick down? And do some of them end up with harmful information? Is it really worth it to help 70% if the net negative to the smaller group is as drastic as homelessness or being consigned to extended day motels, which is where other struggling tenants end up? And finally, just to point out that rent reporting isn't going to fix the racial homeownership gap. It might help done right. But even FICO said something interesting in an article. Their spokesperson said that it's important to note credit scores don't create the social economic disparities. They simply reflect them. And the conversation should focus on addressing the root cause of differences. Now, of course, one problem is that credit scores, by reflecting inequality, perpetuate them because they're used as a gatekeeper. But that spokesperson was correct. They reflect underlying social economic disparities. And until those disparities are fixed, you can use rent information, you can use cash flow information, you're still going to get racial disparities. So with that, I'll turn it over to Q&As now. So thank you. And all of this is, we put out a policy brief about this just a couple of days ago, called it "Even the catch-22s come with catch-22s," because it really is a double catch-22, that rent isn't even reported. And then when it is, it has these downsides for renters. And so there's a link here, and I'll post a link in the chat later with my email. Thank you.
I got to unmute myself. Thanks for that, Chi-Chi. That was really informative. Somebody did just post in the chat, Chi-Chi, and you probably see it, but they are agreeing with you about the junk fees for tenants. And in addition, some of the landlords charge for a parking spot, rent electricity for the parking lot, hallway lights, and for the washers and dryers, which also have a fee to use, plus water, sewer, hookup fees, etc. Okay.
Please let us know about that, because the FTC is the Federal Trade Commission is also going to have a request for comment, and we're going to resubmit our comment. So more information would be great. I'm going to put my email address in the chat.
Great. I'm sure that you're going to hear from the housing counselors. They're not a quiet bunch. All right, so I am going to go to the questions. I want everybody to know that we did set this to go until 3 o'clock so that we would be sure to get to all of the questions. So don't hesitate to put your questions in here, even if you're not going to be able to stay past 2:30, because it will be part of the recording and you can watch it later. So Bill, I'm going to go back to you with that first question that we had about the percentage that removing those fees, the difference that it makes. Were you able to find something out?
Yeah, I checked with our pricing team. So we often have to convert LLPAs into rate. So it's going to depend on the lender, of course, right? Because the delivery fee is charged to the lender back. But we believe it, depending on the lender, will probably result in about a 1/8 or about 12.5 basis points reduction in interest rate to the borrower. So, approximately a 1/8 reduction to assist that borrower out, lender dependent.
Okay, great.
Mhm.
I hope that answers the question. And so Jeffrey, if you need a follow-up, just pop it into the Q&A.
Yep, please do.
Okay, this was Bill, when you and Kenny were talking. The question is, what is the name of the report or link? I'm not sure what report you were discussing.
They may be referencing the equitable housing finance plans.
Okay.
And I can put that in the chat now. Sorry about that.
That'd be great. Thank you. And then there were 4 programs mentioned where the fees are waived, the LLPA fees. Could you mention those again, Bill?
Yeah, sure. Of course. Thanks for the question. So it is first-time home buyers under 100% AMI. So not really a program, but a borrower type. It's under 120% AMI if it's in a high cost area. So that's number 1. Number 2 is, and this is probably of very interest to you all, Home Ready and Home Possible, which are Fannie Mae and Freddie Mac's 97% LTV. That has a very high percentage of first-time home buyers in it as well. That's number 2. Number 3 would be the Enterprise's HFA loan process, HFA Advantage and others that are where they'll take HFA loans through certain lenders. That's number 3. And number 4 would be duty to serve loans. Those tend to be rural properties, et cetera, that both enterprises are under an obligation to continue to increase duty to serve. I think duty to serve plan is public out there. So that would be the 4th one.
Great, thank you. Okay, so this question I think can be answered by either FHA or FHFA or Fannie or Freddie. But so if a tenant has 12 months on-time rental payments and they don't have any credit, or maybe a credit of 500, it will make them eligible to purchase as long as they have been paying on time.
So I can jump in there for FHA, and thank you so much for the question from the participant. So we already have a manually underwritten process for borrowers who don't have a score. So if that were the case, then we already have that positive rental history requirement there. The particular policy that we just rolled out was for automated underwriting. So these are for the borrowers who do have a score, but if a borrower does not have a score, then they would go to the traditional manually underwritten process that's already in place. So that would be the response for that for FHA.
Okay.
Mm-hmm.
So Ellie, could I just jump in a little bit on this?
Sure.
And while we have Julian,
Sure.
I think there's kind of a big difference between what Fannie and Freddie and FHFA are talking about and what HUD is talking about. So that, as I understand it, the documentation has to be, you have to have a bank account that shows 12 months of payment, and it has to be automated. And as I understand what you said, FHA is actually a little different. You would absolutely love that if that's what it happens, but that it's up, the loan officer could be told that if they have 12 months of documentation, so we could take manual documentation, so the canceled checks or receipts or a letter from the landlord, those kinds of things, and they could be used and they would still be put in the automated underwriting, but would need to be verified later. Is that fair to say?
Yes. So as long as they have a credit score, Bruce, then yes, we can use that. And they can also utilize, so it doesn't have to be digital, right? So it doesn't have to necessarily be a bank account, because we will accept, Zelle, for example, or Cash App. So we will use some other type of, funds transfer mechanism if a borrower isn't necessarily using a bank account. So Cash, Zelle, money order, as long as they can substantiate it later in the actual underwriting, it's almost as if they have a finding, right? Like if you were to run somebody through and you have to verify that, it'll give them the consideration for the conditional approval as long as they can support the 12 months, with whatever documentation that they can provide to show that the 12 months was satisfactory.
And in a bunch of our markets, we have people who come in who are really more part of the cash economy, which doesn't mean they don't have bank accounts, but it may be that they manage their, and sometimes it's just to be more conservative. So this, I mean, I think it's important to understand where people fit in the most appropriately.
Yes, but we will absolutely still use cancel checks. We will absolutely use money orders as well. So it doesn't have to be an automated transfer, but we will allow them to be able to support with physical proof of it if it's not an electronic transfer. So yes, money orders and checks still count.
Yeah, and there's an advantage to going through the automated underwriting systems over going to manual, partly because it's faster, but it's also there's some resistance among lenders. It's no big secret about not doing manual underwriting, and some capacity questions. So to the extent that we have provided them in the automated underwriting system, that helps a lot.
Yes.
Thanks.
No problem.
Okay, so the question now shifts over to FHFA or Fannie or Freddie about if a borrower has 12 months of on-time rental payments that they can document and have no credit, does this mean that it makes them eligible to purchase as long as they've been paying on time?
So this is, oh, Bill, did you want to go first? I'm sorry.
No, please go ahead. You
Okay.
guys, you have more details than me. Go ahead.
All right. Well, this is Mindy from Fannie Mae. So the question is, the answer is a little to the question is different, whether they have credit or they don't. So we talked about two things. We talked about underwriting borrowers without traditional credit, and we talked about using an automated rent payment history for those that have a credit score. So if they do not have traditional credit and a credit score, then they would be underwritten using our no credit score borrower feature. And DU underwrites the loan based on non-credit factors. So the LTV, the reserves, the DTI. Then if the case receives an approved recommendation, then the lender needs to document 12 months, or it needs to document two sources of non-traditional credit, one being rent. So then that's where they would document their rent manually, which could be bank statements, money orders, whatever. If they do have a credit score, then that is where the automated positive rent payment feature comes in, where the lender orders a 12-month verification of asset report. DU looks for a payment stream, a 12-month payment stream of that borrower's rent to help improve the recommendation. So they may not need that improvement. They may get an approve without using that positive rent payment history, but if they need it, it could move them into the approved bucket if they weren't going to be there to begin with.
So either way, if I'm understanding correctly, it's important that the consumer be documenting their rent payments in some way through a bank account, mainly is what it sounds like Fannie and Freddie are looking for. Is that correct?
If they want to use the automated piece of it, then yes, it would be beneficial for them to document it through a checking account or some kind of a depository account, whether that be a check or those Zelle, PayPal, the other automated systems. So yeah, that's to use the automated feature. Yes, if they're going to do the manual feature where they're going to manually document the credit, then they could use other sources, obviously.
So then then in both cases with FHA or FHFA, it's important not to be paying cash from your hand to the hand of the landlord. There needs to be some kind of paper trail.
Yes.
Okay.
All right. Yeah, and Ella, just add to that, absolutely critical. And I mentioned that in the opening comments, but it's also for the future beyond rent, right? So I really encourage folks to get, counselors especially, help borrowers get banked, because the enterprises are starting to look at cash flow underwriting and the ability to borrowers to manage their expenses. So while rent's a main topic, the more history we can build up, it will benefit borrowers, years down the road. So it is a benefit beyond rent. I want to stress that there's a whole new world that we're starting to take a look at here, but it really relies on seeing some of that transactional history inside an asset account, like a checking account.
And Julian, was there something more you wanted to add?
Yes, and to Chi-Chi's point earlier about the undue effects of just general broad credit reporting, that you can capture the good with the bad or the bad with the good, which is another reason why we wanted to create, at least from the single family perspective for qualifying for a mortgage, to opt in. So because we knew that the borrowers who would benefit from the positive rental history policy would be the ones that would activate, that they have had the 12 months of positive rental. So that was, the reason why we wanted to use the application as a way for us to, kind of circumvent that, to ensure that only the borrowers who would benefit from positive rental history would actually have the lender click on the identifier that they have the 12 months to actually substantiate it.
Great. Okay, next question. If a kid is renting from a parent, but the transaction of rental payment is a transfer from the kid's banking account to the parent's account, can that be seen as payment of rent?
For FHA, yes, as long as the amount matches what's on the lease, yes.
And anybody from FHFA or Fannie or Freddie?
From a Fannie perspective, I believe so, but I'm double checking. And I believe it depends on how it's reported on the bank statement and if we can see the consistent rent stream.
Okay.
Same answer for Freddie. I have to double check, but I believe the answer is yes. The consistent part is the most important piece, and also that the rent is correctly captured in the loan application too. Sometimes I feel like that's garbage in, garbage out a bit there, and we want to make sure that, because we do use that, right? Because we're looking for that rent payment within a certain tolerance.
Okay, great. Okay, next question. What if a client was late with rent payment in, say, for example, month 6 by a few days? Would that have an impact on their ability to get a mortgage? Does it need to be consistent? Go ahead, Julian.
Okay.
So I think.
Go ahead, Liz. No, I'm sorry. Go ahead.
No, please go ahead.
Okay.
Thank you.
Sorry. We're in a delay. I'm sorry, Liz. You go.
I'm sorry. I think I want to pick up the question a little bit, because I think a couple of days is consistent, right? So we have a tolerance when we're looking at rent payments, because first of all, month is 30 days, except when it's not, right? So we do have a tolerance, but it's a tight tolerance, kind of on the more recent, and it kind of expands as it goes further in the past, because we know that you could be jumping from lease to lease, et cetera. So we do, there is a little bit of a wiggle room there, but I do think, in a couple of days, it still is consistent. Whether you pay on the 1st or the 5th, sometimes you don't get a late charge either way, right? So we do have flexibility there.
But so do you do the 30-day window for the month, or you do the 5-day window? What's the window after the first day of the month?
Can't get into the exact details, but there's a window plus tolerance.
Can I jump in for a minute? On the credit report. So the question seemed to focus on the mortgage underwriting side, but I also want to point out that on the credit bureau side, traditionally payments are not considered late unless they're 30 days late. So if you're 15 days late on your credit card bill, you may get a late fee. You probably get a late fee and you're considered late, but you do not show up as late. What we're hearing from folks on the ground about rent reporting to the credit bureaus is it's not showing up that way, which is actually very troubling, because that makes it inconsistent from the rest of the sort of credit reporting ecosystem, that you're reported late if you're 5 days or 10 days late, depending on the state and when a late fee can be charged. And that kind of destroys some of the value of standardization that you do get with the credit reporting system. And so, as I said, we found that troubling.
And from the underwriting perspective at FHA for the policy, And I posted the mortgagee letter in the chat for everybody. And if you want to find out what it is, it's the highlighted sections of the mortgagee letter, so you don't have to read through everything. But for us, our standard is that if the rental payment is considered to be on time when it is paid within the month that it's due. So we don't have a variance. So if it's due in January and you can show that you made the payment before January 31st, we will consider that positive rental. It doesn't have to be within the first 5 days or 15 days of the month. If it was due in January and you paid it in January, we will consider that positive rental history at FHA.
And from a Fannie Mae perspective, just to kind of round out this question, in terms of, being a few days late, from our side, we don't know when they are late, because we don't know if the rent is due on the 1st of the month, the 15th of the month. We don't know how long it takes that landlord to cash the check. So DU is just looking for consistent payments for 12 months. So it's not looking at a specific day of the month. It's just looking to see if they were paying the amount of rent that was listed on the loan application, if they're consistently paying that amount each month, to show a payment stream for that rent. We're not looking at a specific day. Because we know the days could fluctuate depending on things beyond the borrower's control.
Great. Okay, so this is not a question, but I did want to point it out to the housing counselors on the call. One of the housing counselors in New York State said you all might want to check with your housing finance agency to see if they have any non-traditional credit programs. Because, for example, in New York State, there is a program through the state of New York mortgage agency called Give Us Credit that a lot of their clients have been utilizing. So I think it's a good idea for folks to check with their local state housing finance agency. Just wanted to put that out there. The next question is, how does a landlord register to report timely rent payments?
You want me to take that?
Go ahead, Chi-Chi.
Yeah, it's usually through a third-party service. Fannie Mae and Freddie Mac can speak for themselves on these programs, but from what I understand, they use a third-party vendor. And some of these vendors, a lot of these vendors do charge a fee. The way the credit reporting system works, you need a minimum number of accounts to be what's called an information furnisher or data furnisher, and it's 150, I think, or 200. And so what the third-party providers do is, first of all, they aggregate all that. So, the landlord doesn't need to have that many units, but also they put it in the data in a format that's reportable to the credit bureaus. And some vendors are better than others. The vendors that Fannie Mae, Freddie Mac are using, they look fine. There are some vendors that we found problematic. And there are also some vendors that are part of a tenant screening company. So tenant screening companies are these specialized consumer reporting agencies that are used by landlords to screen tenants. They pull together credit information, eviction records, criminal history, and then they often run them through an algorithm and spit out a recommendation. Some of those are SafeRent, which used to be part of CoreLogic, AppFolio, RealPage, and Yardi is one. So we know that tenant screening can be very problematic. Some of you also may have seen a ProPublica article about how RealPage not only is a tenant screener, but then actually uses this algorithm to tell landlords the maximum amount they can increase the rent, using data from all different sources, including other landlords. And there's an antitrust problem there probably, and it's very problematic. It's causing really big spikes in rent for people.
Okay, thanks, Chi-Chi. So for multifamily properties, is it possible to make on-time rent payments retroactive to the move-in date if the resident has been renting for more than a year? So this is
Sandra. I actually sent that question to the multifamily folks on our team. Hopefully they'll send me an answer, and I'll circle back with you, because while Melinda and I are single family folks. Well, this is a multifamily question, so I'll get back to you all.
Yes,
These
and
are
I can,
Fannie.
yeah, and I can do the same for Ethan Handelman, who's the Deputy Assistant Secretary for Multifamily Housing.
Great.
Mhm.
Louis, did you want to add something?
Yeah, I get a gold star today. I do know the answer to this. I am from single family too, but I do know the answer to this. Yes, they can report past on-time rent payments. So there could be a pretty much immediate impact, positive impact to the credit score.
Great. A couple of different people asked for a link to some of the studies, and these questions came up, Sandra, while you were presenting. Did you point to some studies?
I made mention of some of the studies that our vendors, so our 3 vendors are Isuzu, Jetty, and Rent Dynamics, and Isuzu and Jetty had some findings. So I've also sent that note over to our multifamily folks. If they send me links, I will put them in the chat.
Okay, and anything that you all get, if we sign off of here and you haven't gotten those links yet, feel free to email me, and I will we'll make sure that we get it out to everybody, so that they can have access to the links that you're talking about. Okay.
I mentioned an Urban Institute study. There's a link to it in the policy brief that you posted. And there's also a link to a study by FinReg Lab, which actually has in an appendix a list of different these third-party platforms for rent reporting and how much they charge, if folks are interested in that.
Great. So everybody make sure that you check out Chi-Chi's report, because not only did she write a bunch of really great information, but she also added other information that can be really useful. And I just want to let Bill know that the person who asked the question about the LLPA percentages said that you answered the question. Thank you.
No problem. Thank you.
Okay. For Freddie, is there more information of the 30% of borrowers who didn't see scores go up? Have you seen any scores go down, as Chi-Chi Wu was concerned about?
Or the 30% for the multifamily bit. So
Yeah,
it doesn't negatively. So it won't negatively affect the credit score. So I'd have to get back to our multifamily division whether they were tracking whether it decreases. I mean, Chi-Chi's concern is a valid one. It's about the interpretation of a trade line that's there and then it's not. So I'd have to get back to this group here with a final answer on that.
Great, thank you. Okay, there was a question about that I think we answered about the 30 days late. Okay. Can third-party vendors be added to the chat? There was, I think, as Chi-Chi mentioned, it's inside her report. So those are all the questions there, but I think there's been some questions coming into the chat. So let me just look.
So while you're doing that, let me just jump in with a quick question. And I know Freddie has provided counselors with access to their automated underwriting system. Will that include the rental payment suggestion and the asset suggestion as well?
Yes, that's a broad offering as long as you meet those requirements from the rent payment standpoint, that first-time home buyer, et cetera, and the borrower cash flow is going to be broad to everyone. So when there is opportunity for getting an asset report that's not submitted up front, that we will message to it.
And the counselor will get that message.
Any LPA user will get that message.
Yeah. Okay. Good. Thank you.
Okay. So this question for Fannie and Freddie, if there is no credit score or a low score, how does this impact the cost of mortgage insurance if you're using rent for the underwriting?
The solutions that I've went through do require at least one credit score on the loan.
Okay.
So they don't impact that bit with the non-credit. As Fannie pointed out with their presentation, we also have non-traditional credit avenues you can go for a no score, but the rent payment and the borrower cash flow, you do have to have at least one borrower with a credit score.
Okay. And this is for you, Julian. The FHA effective date is 10/31, but the desktop underwriting update isn't available until the 19th of November. Is there any way to take advantage of this prior to November 19th?
So actually, the update takes place on October 30th. So that's when the actual switchover will happen. So it'll be on October 30th, but it can retroactively be applied to any applications taken after September 21st. I'm sorry, September 20th of 2021. So if there are some borrowers who are already in the pipeline who may have benefited from this, but it just wasn't in place, loan officers can go back almost a year to those borrowers who are in the pipeline and re-decision them after October 30th so they could take advantage of the positive rental. So it actually will take place October 30th is when the update will happen, but can be applied retroactively to any applications that were taken September 20th, 2021 and on.
Okay. Okay, and then I think this is general. We just kind of talked about it, but Julianne, since you didn't answer, but about how the lower scores might affect mortgage insurance and rates.
Yes. So as everyone knows, as far as the mortgage insurance, there aren't loan level pricing adjusters for FHA for the rate or for the mortgage insurance. So basically the qualification, everyone gets the same rate. So if they are approved, whether it's manually or if it's done through the automated system, there are not any considerations for credit that are assessed to mortgage insurance for us. So if you're approved, everyone gets the same rate. But there aren't any contingencies based on credit for mortgage insurance.
And Chi-Chi, did you have something to add? No. Oh, okay. You popped up. I thought maybe you had something to add. Well, that is all of our questions. So thanks again to all of our panelists. This was really great. And I'm going to hand it back over to Bruce to wrap us up.
Excellent. Thank you, everybody. This is really helpful. I think it's pretty important. And we're going to want to do a deeper dive into the electronic capturing of people's cash flow and the kind of pluses and minuses of that, and where that might be able to help our work, and what we need to do to tell clients about that going in the future. So please, if you've got some resources or experience you'd like to share with us, let us know about that as well. We're always interested in cutting edge webinars that we can do that keeps your skill set high and keeps us informed. So I just want to do a quick plug on, we should get to the next screen here. Thank you. A quick plug on joining NHRC. You can now actually join using a credit card. Sorry, this took us so long. We're part of Tides Center, which is a foundation that's the largest nonprofit fiscal sponsor in the country. They're pretty wonderful, but it was complicated to pull this one off. And you really just click in and you go, you'll need to find us, scroll down and find us on the list of the many Tides organizations there are, but we're just listed as National Housing Resource Center, and please consider joining. We have, you can go to our website and grab our application form. We do need that too. And it'll give you the pricing schedule depending on the budget you have for your organization and your housing counseling program. And as Ebony told us right in the very beginning, there are some advantages, but we really think you should join because you help the good work move forward. This gives us the flexibility and ability to do things that are outside of the mainstream, allows us to lobby and represent you well. We don't have any funding source for the jobs board, as an example. It's really paid out of things like membership dues. And we don't have a funder for doing that. And we're really doing a lot of work to expand the pool of people who are going to become housing counselors and try to create a more sense of mission and excitement about the career for people who are joining the workforce. And then we'll always have the discounts on the CoreLogic credit reports. They're the largest provider in the country. It's substantially cheaper than if you went out on your own. And you can do tri-merged credit reports and 3 credit scores. They're all soft pulls. And, you know, I think we should probably start talking about whether it makes sense to even pull 3 or whether we do as well with 2. And I'd love people's thoughts on that. I think there's a movement in the mortgage industry to just rely on 2. So it'd be interesting if people have insights on that as well. And that's a way that you can substantially save money. And there's one credit bureau that's much more expensive than the others. So we'd be happy to fill you in on those details in terms of which one, if that's helpful. But I'd love to know first if we think that's a good idea or not. And you know, we're doing a lot of work in the field on student loans, and Savvy, which is a really great app. You get a substantial discount for that. It's very helpful if you're going to be doing this year after year. A lot of what they have on their website is free, and that's great. But if you want to have kind of an ongoing relationship with them, that could be quite useful. We can save money, and think about that as for your clients, but also think about that as for your as part of your staff, and it's an important tool, we think, for staff retention. It's really a major benefit to people with a public service loan forgiveness option. That's really, really valuable. And then that automates and makes that process easier for you. And then we do occasionally let you know about unusual funding opportunities that kind of outside of the mainstream of the usual funding sources. There's some venturesome grants out there that are looking for innovation. You're a big source of innovation, and we like to try to circulate those. And there's often funds for organizations led by people of color and things like that we try to celebrate as well and circulate to the members list. But you know, real plug is that it is what keeps us going, and so it helps us a lot if you would join. And I know a lot of groups have renewed, but there's a few more that haven't quite gotten around to it. Please do that this year. It really goes into our budget this year. It'll be helpful. You know, that Ebony will post the recording of this as soon as it's available. It'll certainly be up on Monday. Sometimes we can get it up as early as tomorrow afternoon. And we'll circulate resources on the meeting. And I think that's it for us. A big thank you to our participants. This was valuable, and I think I really appreciate the hard work everybody has done on this. So have a good, keep up the good work. We really appreciate all you're doing in the field. Let us know if you've got some great ideas of what more we can be doing. Thanks a lot.